Welcome everyone. My name is Nastassia Arendse. Following up on our fascinating discussion with the team from ZARX listed Dale Capital Group, we once again look at the investment case for Mauritius as an investment destination. And we're going to be having our conversation with my panel of experts who will take investors through key issues relating to the Mauritius business environment. And also we'll be taking your questions a little bit later on in the show, rather on this particular webinar. So to basically discuss all of this, my panel comprises of Faraz Rojid from the Economic Development Board of Mauritius, who will focus on Mauritius as a investment hub. I just want to remind everybody to mute your mics. Thank you. And then we're going to have Graeme Saggers representing Nolands Tax, and he'll be discussing investing offshore, the 10 considerations when going abroad. The presentation will provide an overview of tax and exchange control considerations when South Africans are looking to expand their investment horizon into offshore territories. And then we've got Mark Foulds. He's from Dale Capital Group. He is the non-executive chairman, and he will provide insights into food security and investment opportunities in Mauritius. Just a reminder that the playback facility will be available for all registered delegates. Gentlemen, thank you so much for your time. We're going to start off with Faraz, who's going to be giving his presentation. Faraz, the floor is yours.
Thank you so much, Tas. Let me just load the presentation. Good morning, everybody. My name is Faraz, and I'm from the Economic Development Board of Mauritius. Basically, I'm going to give a snapshot of Mauritius as a jurisdiction, but also as a financial center, and as an important player in driving prosperity and growth and investments into emerging markets. So let me begin with my first slide, which is basically an overview of the Economic Development Board. It is a statutory body governed by the Economic Development Board Act 2018. It operates under the aegis of the Ministry of Finance, Economic Planning and Development, with 4 core mandates: strategic economic planning, trade and investment, business facilitation, and country branding. Now, Mauritius as a jurisdiction, first of all, it is important to note that Mauritius is a country of 1.3 million of people. It has a GNI per capita of approximately, this figure is outdated, it is $14,000. By virtue of this threshold, we are a high-income country as per the definition of the World Bank. But noting the COVID-19 pandemic, where the global economy is suffering, I'm pretty sure that our high-income status would be reviewed in a month or a couple of years to come. Mauritius is a country that boasts a hybrid legal system. That is, it is a country which has English common law as well as the French Napoleonic Code. And the highest court of appeal of Mauritius, and this is an area that gives a lot of comfort to the international investing community, is that the last court of appeal is the Judicial Committee of the Privy Council in the United Kingdom. And we've retained that despite the fact that our court system in Mauritius and the Supreme Court as the highest authority in Mauritius is one of the best in this part of the world, and if not in most of the jurisdictions across the world. We have had an economic growth of 3%. Mauritius is a country that is rated Baa1 by Moody's, and it is one of the 4 investment grade countries in Africa, but it is the only investment grade international financial center in Africa by virtue of the definition of IFCs. We have free and fair elections every 5 years, and a conducive time zone of GMT +4. Now, before I go into the nitty-gritties of Mauritius as a financial center, I wanted to enumerate a few of the highest grossing sectors of the jurisdiction, and where the attendees in over and above the financial services sector or using Mauritius as a financial center, they may also have a penchant to invest in certain sectors. So in terms of the GDP spread of Mauritius, the highest grossing sector is the manufacturing sector at 12.6% of the GDP. You have the financial services sector, which is 11.8%. And then you have the tourism and ocean economy at 10.8%, and real estate, immovable properties, high-end luxurious villas, amongst others, at 10.8%. Now, followed to that is, of course, you have a number of business opportunities in the logistics sector, in the creative industry, including filmmaking, film shooting, but at the same time, high value addition after post-production facilities in Mauritius. Education is one of the important segments of the jurisdiction, as is ICT and the healthcare system. Now, without taking too much of time, I wanted to talk a little bit about the Mauritius Financial Center. At the heart of what we offer to the international investing community, there is a two-pronged approach. First is servicing the multinational corporations and the corporates across the world. And secondly is the value that we add as a jurisdiction to the wealth, the private wealth of high net worth individuals. And those two prongs are spread into four limbs of what it is that we offer as a jurisdiction. First one is the banking and insurance segment. I'm going to talk a little bit about the banking sector in my next slide, but Mauritius has had a very successful graduation towards the sophistication in the banking sector as well as in the insurance sector. We offer both conventional and Islamic banking, investment banking, and private banking, amongst others. The second limb to what we offer as an international financial center is mostly the value that we add to corporates, including through investment holding entities, fund management, global funds, the use of trusts and foundations, protected cell companies for segregated structuring purposes, but as well as headquartering and treasury management, amongst others. Thirdly, you have the Stock Exchange of Mauritius, which is one of the few exchanges across the world that you can list, trade, and settle in euros, South African rands, pounds, and United States dollars. It is a member of the World Federation of Exchanges. And then at the back of it all is a very sophisticated industry, which we call the professional services industry, where you have international law firms, you have accountancy firms, and you have qualified professionals, amongst others. Now, I mentioned earlier that I'm going to talk a little bit about the banking sector. I think the international investing community and our attendees here looking at my presentation will want to know how strong it is as a jurisdiction, especially as an international financial center. So at the heart of every financial center and every economy, actually, you have the banking sector. And in Mauritius, you have 20 domestic and international banks. The big names are here as well. As per the international standards, the capital adequacy ratio is supposed to be approximately 12%. For tier 1 capital. The capital adequacy ratio in Mauritius is 19.2%, which gives you a fairly straightforward indication of how resilient and how strong the banking sector is. In terms of the stock exchange, you have more than $8 billion of market cap with over 200 listed securities. And you have 51 law firms, 6 investment banks, 3,000 professional accountants, and a number of the people well versed with the jurisdiction will tell you that it is one of the few countries in the world where you have the highest number of accountants per capita. Now, going back to what it is that we do as a financial center, Mauritius is a hub. It is a vibrant hub for international corporations and funds. So as we are speaking now, there are more than 12,000 companies that have been structured and domiciled in Mauritius and which are conducting businesses outside of Mauritius. Out of these 12,000 companies, you have approximately 1,000 global funds, and the asset under management of those funds are approximately $800 billion of dollars. Which gives you an idea of that we are punching way above our belt when it comes to the GDP slash funds administration and management. There are more than 15,000 people directly employed in the financial services sector, with a GDP contribution of 11.8%, as I mentioned earlier, but it is one of the highest grossing sectors in Mauritius, with a growth rate of 5.2% for the past for the past 5 years. Now, those 12,000 companies, this is the geographical spread of the value of investments, where you see most of the source of investments coming through the financial center into emerging markets, into other parts of the world, are predominantly from Northern America and Europe. But at the same time, you see a fairly big amount of capital flowing in from Asia and Africa. And as a conduit for investment and as a hub for investment, you would see that Asia and Africa are our main servicing markets. Now, why is it that that Mauritius has an advantage when it comes to pooling of capital, but also adding value to multinational corporations, and why a number of exceptionally affluent individuals and families use Mauritius? Is basically you have the ability to incorporate a company within 2 hours. You have a flat tax rate in Mauritius of 15% with a partial exemption of 80%. But of course, you have, as part of the restructuring of the economy following the global pandemic, there is also a solidarity levy that is imposed on the earnings being done in Mauritius. You have high bandwidth connectivity, and you have the ability of you have the availability of highly qualified bilingual professionals that can service your enterprises or your wealth and grow your wealth around the clock. Now, another important USP for the Mauritius jurisdiction is the extensive network of bilateral treaties. We have 45 bilateral investment treaties, and we have 52 double taxation avoidance convention agreements. Now, the convention agreements, when it comes to avoidance of double taxation, is fairly straightforward, but I wanted to delve a little bit more in terms of the bilateral investment treaties, or what we call the investment promotion and protection agreements. These are the treaties that mitigate a number of risks when it comes to investing in other jurisdictions. So the bilateral investment treaties in Mauritius provides national treatment for compensation of losses, for instance, in terms of civil strife. It has a guarantee against expropriation. So if you're structured through Mauritius and you're going in a country, there's a guarantee against expropriation and your investments are covered. All of our bilateral investment treaties have de facto arbitration clauses, and that has already been consented at the outset. Therefore, if you feel that your rights under the bilateral investment treaty has been affected, you have the right to go to arbitration rather than going through domestic courts. And one of the most noted arbitration facilities that investors using Mauritius to invest use is the ICSID of the World Bank, which is in New York. It is the International Center for Settlement of Investment Disputes. And of course, all our treaties guarantee free repatriation of capital and profits. And at the same time, there is a subrogation clause. Therefore, if you wish to use the Mauritius jurisdiction and you're protected by a treaty, you can always go to a political risk insurer, like an institutional arrangement like the MIGA, the Multilateral investment guarantee agency of the World Bank, for which Mauritius is a signatory to the convention. But at the same time, you can go to any private political risk insurance company, and you take an insurance for the political risks that may arise with regard to investment, compensation of losses, civil strife, expropriation, nullification, etc. And because of this subrogation clause, the political risk insurer, if your rights are impaired, they can pay you directly what is lost under your coverage, and then they step in your shoes to sue the host government in arbitration or in courts. And this is the subrogation clause. Now, Mauritius has also been a proven and trusted leading financial center by a number of companies, including our host today, Nolands, amongst others, but you have all the big names enumerated in this slide, and I wanted to share this with you. And then just two things before I end, Nastassia. I know that you're fairly very rigid when it comes to timing, and it should be that way. There are two things. First is over and above the number of sophisticated products that the jurisdiction offer to the international investing community, you also have the Global Headquarters Administration License, which is basically you set up shop in Mauritius, your headquarters and your treasury management center in Mauritius. You have your substance requirement in Mauritius, and you satisfy the substance requirements in Mauritius, including minimum annual expenditure, including professional residence that should be in Mauritius, and your activities, which is basically administration and general management, economic and investment research and analysis, amongst others. You get a tax holidays for all the income that is accrued to your headquarters for a period of 8 years. Now, these and all the other products have undergone what we call the peer-to-peer review at the level of the OECD and the Forum on Harmful Tax Practices, as well as the Code of Conduct Group by the European Union. And all of these products have been whitelisted by the OECD and the EU. Now, another segment, I've spoken about the corporates, but as part of the private wealth segment, we also have the overseas family office, which is basically all those families wishing to redomicile their asset and wealth, or part of their wealth, to Mauritius and grow their wealth out of Mauritius. I have two types of family offices, single family office and overseas family office. The minimum investable wealth of each family is $5 million, and you have substance requirement as well, but you get a tax holidays of 5 years for the income derived by the family offices. At the same time, you get an occupation permit in Mauritius, which is the work and live permit in Mauritius. And this is what I'm going to end my presentation on. So it will just be 1 more minute, Nastassia. The first one is, we have the occupation permit in Mauritius. It has 4 categories. It's basically investor or professional or self-employed. And you also have innovators occupation permit. The minimum investment of an investor is $100,000 in Mauritius, but we've reduced it to $50,000 in Mauritius with a turnover of 4 million of rupees. The professionals, you need to be employed in Mauritius and you need to be deriving an income of more than 60,000 rupees, which is approximately $1,500. If you're a self-employed, your minimum investment is $35,000. And given the fact that we understand that the COVID pandemic may affect the flows of income for the self-employed, we have removed the threshold that you need to show business income from year 1. We have changed it to year 3. And if you're an innovator and you're accredited and approved by the EDB and the MRIC, there is no minimum investment required. So we want to open our borders for the young, bright minds out there. At the same time, the occupation permit, it used to be 3 years the validity, which is renewable. Now, after the last budget, which is the equivalent of the State of the Union address by the Minister of Finance, the period of occupation permit is now 10 years. And if you have an occupation permit in Mauritius, whether you come in as an investor or professional, etc., you have the right for dependents in Mauritius. So your spouse and children below 21 years of age or 18 years of age will be able to live in Mauritius together with you. You will also be able to acquire immovable properties in selected schemes. And if you're a professional, you have the ability to invest also in a number of other investment opportunities that you see, despite the fact that you're a professional. This was opened through the last budget as well. So in a snapshot now, Blasi, and I want to end on this one. If you are an investor investing in Mauritius, and if you're acquiring an immovable property, it used to be at $500,000 used to get a permanent residence permit in Mauritius, which was valid for 10 years. Now we have reduced that threshold to $375,000, and then you get a permanent residence permit for as long as you hold the property. So in a nutshell, this was Mauritius as an international financial center and as an investment destination. Thank you for your kind attention.
All right, thank you so much to Faraz Rojid from the Economic Development Board of Mauritius and that very interesting presentation. And we've had a few participants asking if this presentation will be available for them afterwards, if there's anything that they've missed. Yes, it is available on request, and of course, as well as the contact details if you want to take the conversation forward with any of the panel members. We now move on to the next presentation, and that is from Graeme Saggers, who is from Nolands Tax. And he will be talking about investing offshore, 10 considerations when going abroad. Graeme, the floor is yours.
Thank you, Nastassia. Thank you for having me. Good morning, everyone. Although Mauritius does have the highest number of accountants per capita, I'm based in Cape Town, but as Faraz said, Nolands does have an office there, and we've been happy residents there for a number of years. So we work from Cape Town quite closely with our office there. I'm going to work quite quickly through 10 considerations. Obviously, there's a broad number of people on this webinar that may be looking abroad for various different reasons. So I really just wanted to give a snapshot or a high-level overview of some of the things that you should be thinking about when making this decision to go abroad. The first thing is really to think before you go. Whilst Mauritius and many places look like paradise and they can be very exciting, it's important not to just jump into it. And so, yeah, always get good advice and understand your risks. It's better to understand the risks before you go than be aware of the consequences after you've gone. So really do your homework up front and get good advice. From a South African perspective, what we need to understand is that South Africa operates on a residency-based tax system. So South African tax residents are taxed on their worldwide income. This is applicable to both companies and individuals. So that's important because in looking at this decision, the concept of tax residency becomes extremely important, and knowing when you are tax residents of which country and what the consequences are of moving tax residency. An overview from an individual perspective is that in South Africa, there are three aspects to an individual's tax residency. There is what's called ordinary residence, which is if South Africa is your home. It's a common law test, which will depend on a number of factors. There's a number of days, a physical presence test, which applies over a 6-year period. That is more often than not designed to capture or bring foreigners into the tax net that have settled in South Africa rather than South Africans moving abroad. But the third, which is probably most important in this context, is if you are tax residents of another country in terms of their domestic legislation, and there is a double taxation agreement between the two countries, then we need to look at the tiebreaker rules in the double taxation agreements. So South Africa and Mauritius do have a DTA. It was renegotiated, I think, in 2013. The new one came into force. It's quite standard. It follows the OECD model. But what's important here is that when people resettle abroad through potentially one of the investment programs that we spoke about, it may mean that they satisfy the Mauritian residency rules, but if they also satisfy the South African rules, then we need to apply the tiebreaker test. And that may mean that you have ceased to be South African resident without realizing it. And when you move tax residency, so if you cease to be South African tax residents, there is a deemed disposal of all your worldwide assets, which will cause capital gains tax events. This is what people refer to as like an exit tax. It's not really a specific tax applied as like an exit levy or anything like that. You just deem to have disposed of all your assets, and then you'll need to pay capital gains tax on it. South African property is excluded from that because foreigners in any case pay CGT on their South African property. So you're really at risk of having a CGT gain where you have maybe investments in local South African companies or some unit trusts or share portfolios or potentially foreign properties. So it is very important to establish when potentially there is a date that you would cease to be resident, because you would then need to notify SARS, and you do that by declaring it in your tax return. This concept of tax residency has been a very big topic in the media over the last few years due to some changes in legislation on foreign employment income, and something that we've been consulting on a lot. Another thing that I'll just touch on is that a lot of people consider what we call financial immigration, which is your Reserve Bank immigration. I don't have time to go into detail on it, but just a comment is that it is not a determinant of your tax residency. It's something that is a persuasive factor, but it is not a determinant. And we have been notified in the budget speech this year that the concept of financial immigration will fall away next year. So there will be new exchange control regulations enforced by March next year. So one needs to just be aware of that. For an individual in South Africa looking to invest abroad, we need to consider the Reserve Bank exchange control allowances. So the South African resident can take R1 million per year offshore relatively easily. That is what used to be called the travel allowance. So that's a R1 million allowance per South African resident major individual per calendar year. So a husband and wife can each take R1 million off. They can take it off in December and then another million in January. It applies per calendar year, and that the approval process of that sits with your bank. So it is quite a straightforward process to take that R1 million off. Then there is a further R10 million allowance, which is your foreign investment allowance. That is a bit more of a stringent process. Effectively, you need a tax clearance certificate. As part of that, you need to submit 3 years of assets and liability statements. You need to prove that you have the funds available and show the source of funds. But yeah, it's not a very difficult process. The turnaround time with SARS on those tax clearance certificates, if you've got all the information, is quite quick. We're seeing them come back in a week, 2 weeks. So it's not a very difficult process. If you then have a further requirement to take more than the additional 10 million, then you can apply for special clearance, but that's obviously a much more detailed process with the Reserve Bank. From a company perspective, companies can get a bit more complicated when it comes to residency. It's not as simple as just saying where the company is registered. Mauritius, over the last few years, have amended their legislation somewhat to legislate this concept of substance, which came through the OECD recommendations as a result of the whole study into base erosion and profit shifting, which has been widely reported on in the press. So effectively what substance means is that depending on the type of company that you have in Mauritius, there'll be certain requirements that you have to comply with in terms of number of local directors and experience of directors. And it's a lot more involved now than just having Mauritian resident directors. There needs to be like, in a common sense, substance to their appointment. There should be people that have experience in the industry of the company that they're directors of. But overriding that is this concept of effective management. So effective management is something in the South African domestic legislation, which says that no matter where a company is registered, if it is effectively managed in South Africa, it will be tax residents in South Africa. So again, similarly to the individuals, you may end up in a situation where a company is effectively managed in South Africa, but has substance in Mauritius, which will again bring you back to the double taxation agreements. And we then need to look at that to determine who has taxing rights. Quite interestingly, in the Mauritius, South Africa DTA, they do revert back to effective management. So looking again at where the key strategic decisions of the company are made. But they get to a point in the DTA where they say, if we can't determine which country has taxing rights, then the competent authorities of the two countries will meet and they'll decide. So that would take the decision completely out of your hands. So that is something that needs to be borne in mind if there is, maybe a gray area on this. Yeah, I'm going to just very briefly in terms of offshore structures. I'm not going to go into detail on the different Mauritian companies that you can set up. Obviously, when looking offshore, one would need to look at the jurisdiction, understand their structures there, understand the incentives. As Faraz said, there's various very attractive incentives in Mauritius. Quite typically, people would usually have a company which would be held by a foreign trust. But again, that's the foreign trusts are something that SARS is putting a lot of attention towards. There have been legislative amendments on foreign trusts. So when going that route, one needs to really get updated tax advice in order to understand what the consequences are when you start receiving benefits back into South Africa. In terms of local structures, I just wanted to mention very quickly that in South Africa, there is also a concept which is vastly underutilized called a South African headquarter company. And the headquarter company regime is aimed at relaxing some of the exchange control and foreign investment requirements as an incentive for South Africans to invest abroad. So if there is a trading intention abroad rather than a passive investment intention, then it is worth also looking from a South African perspective how best to structure it. Ultimately, at a very high level, when going abroad, the good situation to be in is when you're in some sort of a JV or joint investment type opportunity with a foreigner. And the reason why I say that is one needs to be very careful of controlled foreign companies. So a controlled foreign company from a South African tax perspective is a company abroad where more than 50% of the equity or voting rights is held or controlled by South Africans. So again, that doesn't mean that if you as a South African hold less than 50%, you're out of controlled foreign companies. You need to look at all the shareholders. So if you have 3 South Africans each holding 33.3%, it will be a controlled foreign company. If it's a controlled foreign company, it means that the net income of that company would need to be recalculated as if it was a South African company. So it doesn't make that company tax residents in South Africa, but the net income when applying the South African tax laws would be taxable in the shareholders' hands in South Africa. There are exclusions in there. Again, if it is a fixed company with a fixed business establishment in the foreign country, then you'll get exclusions around that. But ultimately, as a South African shareholder of a foreign company, if you're outside of controlled foreign company territory, and if you hold more than 10% in the foreign company, then there's a really nice incentive in South African tax law called the participation exemption. So if you hold more than 10% of shares in a foreign company, you won't pay tax in South Africa on dividends received from that foreign company. You also won't pay capital gains tax in South Africa when you sell that company. So the kind of magic spot to be is between 10 and 49% shareholding in the foreign company. And yeah, the last thing I just really wanted to mention when looking abroad is, as I start off by saying, is get good advice. So get in tax, especially in the international tax space at the moment, things are moving very quickly. There's a lot of attention. There's a lot of attention on lower tax jurisdictions. There's a lot of attention in the digital space. The concepts that we used to deal with of physical presence are changing as we move more digitally. So it is a very dynamic environment at the moment. So really get strong advice and go through any of your considerations in detail, and make sure that you're protected. This is my team. We're around nationally in South Africa and have experience abroad, so we're able to help you with anything you're looking for. Thank you.
All right, Graeme, thank you so much. Just a reminder to all the attendees, if you have any questions for our previous speaker, Graeme, as well as Faraz, you can post them in the chat session, and then I'll get to them a little bit later on. The next speaker is Mark Foulds. He's the Dale Capital Group non-executive chairman, and he's going to be providing insights into food security and investment opportunities in Mauritius. Mark?
Anastasia, yes, thank you very much. I see I've got 9 minutes left on the original schedule, so I'm going to have to be particularly efficient. So let me, can you see my presentation?
Yes.
Okay, perfect. All right, well, look, thank you very much and welcome to everyone for participating in this webinar. I'm going to try and talk a little bit about the background to food security, and particularly, I think, in the context of Mauritius, where there are some significant opportunities, and talk a little bit about how Dale Capital, how we're trying to make the most of those opportunities. So
Mark,
first you just, yes.
Kick off. Apparently, I can give you an extra few minutes just so that you get your points through succinctly.
Okay, that's marvelous. Thank you. Thank you very much for that. So just looking a little bit about what Dale Capital actually is. So we are a niche African-focused private equity company. But I think in the context of the webinar today, what makes it interesting is that we have a dedicated focus on food and food security in Mauritius as a key part of our investment strategy. So the company itself was founded in 1996, but we were incorporated in Mauritius in 2000, and then registered by continuation in the BVI in 2007. We've had a number of different investments over the time, all of which historically have given to a very attractive growth in NAV for the business, and certainly up until the crash in 2009, what was a very attractive dividend distribution policy. So we have a number of milestones to the company. We were the first foreign listing on the Stock Exchange of Mauritius in 2007, and we were the first listing on Zarex in South Africa. But we in essence have been involved in Mauritian and Mauritian businesses for over 20 years. And I had a number of very successful investments in there, including the Belamigo Group, which is one of the leading fish processing companies on the island of Mauritius, and also in Afrasia Bank, where Dale was one of the founder investors. We've probably invested over $12 million in the food security space, particularly over the last 5 or 6 years. A number of our projects have been relatively early stage or turnaround investing. And historically, all of our funding has come from high net worth individuals or family offices who have been particularly close to the group and who bought into the investment strategy. And one of the things that we are actively trying to do now, and it's particularly as a result of the Zarex listing, is to try to attract some institutional money and obviously more family office money to come and support the projects that we're doing here. So as I mentioned, that we're actually raising $5 million at the moment for all our food security investments. We will be raising larger sums of money for slightly different type of projects that I'll talk about a little bit later in the presentation. So again, you know, we've seen a very significant increase in our assets under management and net asset value over the last couple of years. Quite a lot of this due to the fact that a lot of these projects are relatively early stage, and they are literally reaching some significant traction now, and we need to find the additional funds to carry on fueling that growth. So just talking a little bit about food security in general. And I think it's worthwhile just stepping back and looking at some of the macro issues that is making this such a sensitive topic that you'll see really in a lot of different forums. And I think part of the importance is driven by the fact that a lot of the emerging countries and highly populated countries are enjoying higher standards of living and have higher demands on both the volume and the quality of the food products that they're consuming now. I think the second point worth raising is that we are entering a much more volatile period from a climate perspective. And we're seeing increased extreme weather and crop failures. And I think we've had enough example over the last 18 months from Australia to India and to New Zealand to see what that means. And all of that means that countries that historically have been exporting food may actually limit what they do unless there are other sources of food production that are found elsewhere. I also added in switch of fossil fuels to biofuels. That's just another drain on available agricultural land that has different usage. And I think that overall volatility in the food space is increased with speculation in food commodities, which again is also increased by the volatility in climate change that we're seeing. So I think the paradigm that in the past that if you had money, you could buy food isn't actually necessarily the case, and that there is a significant risk that food exporting countries may actually limit their exports in the future. So if I look at Mauritius as a case, you know, in the light of those macro considerations, Mauritius has a number of other factors that make it even more important to them. I mean, it's a small island state. It's physically isolated away from a lot of the major continents and food producing areas. It has relatively small internal markets by global standards. And that actually has an impact on the ability of the country to achieve economies of scale in a number of the food sectors. And it also has a high vulnerability to natural and environmental disasters, which I'm not specifically going to talk about in this presentation. But all of that leads it to have a very high dependency on imports at the moment, which is not necessarily an attractive space to be in. So putting the island actually into its context, it actually has a landmass of only slightly more than 2,000 square kilometers, but it has an exclusive economic zone of over 2 million square kilometers. It actually gives it one of the biggest economic zones for almost any country, certainly in the Indian Ocean. As we heard earlier on, there's 1.3 million residents. There's about 1.4 million tourists that go there. So that at any one time on the island, there is between 1.4 and 1.5 million people, all of which are consuming food. So again, I think some of these statistics were brought out in the first presentation, but if I look at the contribution of agriculture on the right-hand slide is actually less than 4% now. What's interesting is looking at the decline in the GDP share of agriculture over the last 25 years, which you can see on the left-hand slide. And you'll see that it has had a very, very significant decline. And part of that decline has come through the decline of the sugar industry. And you can see on the central slide that the total area harvested for sugarcane production has been reduced by about a third over the last 25 years. And what we found is that currently there's about 90% of the arable land that is used for sugarcane. But for a lot of the smaller producers that are non-mechanized and are not necessarily in the flatter areas, they just can't make sugar work economically. And so you're finding you've got arable land, or potentially arable land, that has actually just been abandoned. And I think there's one of the reasons why it becomes not only an economic reason, but also a strategic social reason to try and diversify that land use and actually restart growing additional crops. So in summary, Mauritius currently imports over 70% of all the food that it consumes on the island. And those imports will vary considerably across food types, and I've got a slide a little bit later that I can give you some examples of that. And there are a lot of reasons why this diversification is taking time to do, and some of it's linked to poor skills, some of it's linked to land availability, some of it is linked to the complexities of growing food crops on the island because of the extreme weather conditions, and all of that requires know-how and technology, which historically has not been prevalent on the island. So I couldn't do a presentation without having some kind of comment on COVID. It's obviously been a major upheaval for the tourism and hotel and restaurant sector. But it's interesting, I think, in the context of food security, is just to look a little bit at food inflation. And I found a slide from Trading Economics that just showed how that the problems of supply to the island, particularly at a time when the logistic chains were strained during COVID, led to a significant increase in food inflation. And I think that for me, COVID is a strong catalyst for change, and particularly for reform in the food supply chain for Mauritius. And we know that there is significant government support for this. And this is part of the background as to why we believe that there are going to be, or there are already, some very attractive opportunities in the food space there. So just very quickly on the food balance, I've given some examples here. There are clearly products that you're not going to grow in Mauritius because you're never going to get economies of scale. So right at the top of the list, you'll see that products such as wheat and maize, those are almost always going to be imported. But there are areas where there are niches. I've highlighted a few of them, sectors that either we're already in or that we are interested in looking at. So you can see tree nuts. The island is relatively self-sufficient on poultry, but not at all on lamb or goat meat, and not on beef either. So all of these are opportunities that, with the right technology and the right people, that we believe we can exploit on the island. So the government sets out every 5 years a national development plan, and this is the last plan that we could find, and it's basically runs out at the end of this year. And it is the strategic vision of the government to create an integrated development to build vibrant non-sugar agriculture and agribusiness sectors that utilize natural resources sustainably and contribute significantly to national food security. So in essence, they need to increase production of high quality strategic crops and vegetables, not only to satisfy local demand, but also as a potential platform for exports, which was not a significant part of this development plan. So that was the background as to why we felt there was something attractive to do there. And if I look at where our food activities currently sit today, we're present in 3 main operational areas. So the first is food import and distribution. So we have a food distribution business where we're importing a number of well-known South African brands and distributing into the restaurant, hotel, and supermarket sectors onto the island. We also have a meat wholesale distribution business, which is showing some significant traction. We have a livestock and agriculture sector. So we have the largest herd of goat and sheep on the island at the moment. We are just under 2,000 animals, but we have plans to ramp that up as a result of our strategic partnership with the Felix and the Robert family group, to ramp that up to between 8,000 and 10,000 animals over the next 3 years. And we have our fishing and fish processing business. We talked about the size of the economic zones surrounding Mauritius, and the blue ocean economy has to be exploited over the coming years. So one of the interesting things about Mauritius is looking at how you can develop an integrated model, and one of the areas that we look closely at is how we can capture different sectors of the value chain, from raising the animals to processing them, processing the meat, creating value-added products from that meat, and then actually distributing it out, both to third parties, but also potentially to our own retail outlets. So currently we have our 4 food divisions. You can see the seafood division. We have our livestock, where we have our goats and sheep. We have our food logistics division. And we have some Felix Fine Foods, which will be our retail outlets that we're in the process of opening. But you can also see up at the top that we've actually added in a few grey areas. These are not grey areas, these are in terms of finalising, and these will give us the opportunity to have a different investment space in parallel to the food space, both in financial technology and also in a very strong sector on the island. So I mentioned at the beginning, we're looking to raise $5 million. Most of it is to provide operational working capital and CapEx to grow the existing businesses that we have that are gaining traction. But we will also have a second stage fundraising of 60 million to fund some of the commercial property development opportunities that we have as well. Other food and food security related projects that we have on the go, we are going to put in an aquaculture project, again on the St. Felix Sugar Estate land, to grow tilapia. Likewise, organic and biofarming, there's again significant opportunities on the island to develop that. And also to increase the amount of value added that we're doing in our food products. So there's a lot of ideas that we have for that, and I think I mentioned already the delicatessen stores. So all of these projects have very attractive dollar rates of return, and obviously for those investors who are particularly interested, we can obviously share some information. We can't share all information as a listed company, but we can obviously give insight into where we think the value is going to be created from these projects. So I mentioned a little bit property development. We are very lucky to have a strategic partnership with the Robert family and the St. Felix Sugar Estates. The big attraction for Dale is that they have access to significant amounts of land on which we'll be able to roll out a lot of these food security projects. They also, on their side, have a very important project to develop a smart city on the island, which is a very, very large property development encompassing commercial, residential, and lifestyle properties. And we will be very close to them. We will get involved, at least in some of the sections of this development that come available to us. So thank you very much for listening, and I know we've gone over by 5 or 8 minutes on stage, so thank you very much for indulging me a little bit and giving me a little bit more time.
Thank you so much, Mark. There's some questions that have been coming through, and I think we have Faraz still on with us. Perhaps you can take this one. It's quite a long one, so I'm going to try and read it quite quickly. And it says, the EU recommended Mauritius to be added to its blacklist on money laundering and terrorist financing earlier in 2020. What is the current status of this recommendation, and has it either been avoided or affected, or when is it kicking in? Would you be able to know about this?
Yeah, sure. I mean, there are two answers to it. One is the long answer, and the second one is the short answer. But I think for the benefit of the attendees, I would opt for the long answer if you allow me. You know, the AML-CFT, which is the anti-money laundering and combating of financing of terrorism activities standards, is governed by the Financial Action Task Force. Now, the FATF has 40 recommendations and 58 recommended actions when it comes to the system that is in place and the effectiveness of that system in combating the financing of terrorism and preventing anti-money laundering offenses in the jurisdiction. Now, we started having a review at the level of the jurisdiction, Mauritius, but not only Mauritius, and we had a number of other countries. We started doing our review of our AML-CFT systems in 2018. Now, based on the preliminary assessment, which is called a mutual evaluation report, in 2018, the FATF and its regional body, which is the ESAMLAC, the Eastern and Southern African Anti-Money Laundering Group, they said that Mauritius had only 14 out of the 40 recommendations and very weak effectiveness when it came to those recommendations out of the 58 recommended actions. So we established a timeline with the Financial Action Task Force, and we have always been ahead of the timeline. And within 1 year, we jumped from 14 to 35 compliance of the recommendations, right? That is in the technical compliance. And then you have the effectiveness. How effective are the systems that you put in place based on the 40 recommendations, including we have adhered to the big 6 FATF recommendations as well. There we are compliant with 53 out of the 58 recommended actions in terms of effectiveness. And because of these, I'm going to fast forward a little bit, because of these 5 strategic deficiencies, if we may call them, on the effectiveness of our AML-CFT, the FATF placed us on their watch list, which is basically a light gray list of the Financial Action Task Force in February of this year. The EU came in May, where they conflated all the lists that the FATF has. FATF has one black list and one dark gray list, which is not a monitoring list, but it is the countries which have strategic deficiencies, but they haven't given sufficient indication that they are going to address them. And then a light gray list, as Mauritius is in it, where you have strategic deficiencies, but the government has already given the highest level commitment, and in Mauritius it was done by the Prime Minister, that it will address those strategic deficiencies. So the EU conflated all of these 3 lists and came up with their blacklist through a delegated regulation by the Parliament, and this delegated regulation will come into force on the 1st of October. We asked the EU to do an assessment of the jurisdiction and see how Mauritius is affecting the financial stability of the European Union through deficiencies in our AML-CFT regime. But the EU said no, they are going to base themselves on the FATF list. But the FATF list, Mauritius has already provided a number of reports, of updates. We call those progress reports that give an indication of what are the work that we have already accomplished. Now, the EU said you have to get out of the FATF list and automatically will take you off the EU list. To get out of the FATF list, our latest report that we submitted was in August, in July/August, and it has to go to the preliminary plenary session of the Financial Action Task Force on February. As an indication, given the fact that it is, I'm not sure what would the report of the FATF say, but effectiveness is very subjective. And it could be that the plenary session would feel that we have already complied with the effectiveness, or they may say, just for the sake of looking at the sustainability of the effectiveness measures, they would want to wait for one more plenary cycle, which would bring it into July next year. I hope I answered the question. It's a bit technical, but it's a bit long as well. But at least it gives an indication of how the EU list came about. The EU list came about built on the FATF list. And the FATF list, there is a timeline and there is an agreed schedule on when we are going to submit updates and how they're going to look at it.
Right, I'm gonna borrow a couple of minutes. Mark, this one is for you. And the question says, is beef feedlots used in Mauritius, is it viable versus importing livestock or processed beef products?
Sorry, just repeat the question. It says, is beef feedlot?
Yes, I think it would say, are beef feedlots used in Mauritius? Are they viable versus importing livestock or processed beef products?
Well, look, I think that's a kind of, there are a number of different food stocks that are imported onto the island. There are a number of companies that do that. I think the beef population on the island, I'm not sure what the current figures actually are, because there was a herd of cows on the island, but I think that was actually, I think that went into receivership about 12 to 18 months ago. So I don't actually know who is importing specifically fodder for cattle on the island now. So I'm not sure I've answered the question properly, but
that's fine. Unfortunately, we have run out of time. Thank you to everyone who's joined us and everybody's contact details. If there's any questions you want clarified, or you need a little bit more information, or you want to take the discussion even further, we will provide those questions and those presentations if you want to go back to them. The playback facility will be available after this for those who have missed it. Thank you so much, gentlemen, Graeme, Mark, and Faraz for joining us. Thank you.